Are you a high income earning professional who is wondering what the top mistakes are that you could possibly make when investing passively, especially in passive real estate deals? Well, if that is you, we are going to tackle those top mistakes that high net worth investors make when they either get started investing passively, or they've been in the passive investing game for a few years and are trying to scale their portfolio. So we do this masterclass live every Tuesday to help you learn the ins and outs of passive investing so you can go into your next deal with confidence. So we help you take your active income, turn it into passive income and long-term wealth. So maybe you've actually tried investing passively before but couldn't get comfortable with the deal, or you actually went into a deal and realized it wasn't a good fit, or you're a seasoned investor and simply want to sharpen your skills. You're in the right place. Now, if this is the first time you and I are meeting, my name is Whitney Elkins-Hutten. I'm the Director of Investor Education here at PassiveInvesting.com, and I walk the talk. I've been investing in real estate since 2002, both actively and passively. I would say a large portion of my portfolio now is passive investments. Why? It's because if you're watching the video, you see my crazy crew pictured here. This is what I love doing, is spending time in the outdoors with my family, with my friends, and traveling the world. But it wasn't always like that. I actually started off very actively working a W-2 job. I still work today. I'll explain why here in just a second. But also, I was figuring out how to take all of that active income and turn it into passive income so I could buy back my time. And I document that journey in my book, Money for Tomorrow, published with Bigger Pockets. But again, it's what has got me true financial freedom. It wasn't owning the 40 single family rentals or being a general partnership on 10 multifamily buildings or starting the various side businesses that I've started. It's actually learning how to take my active income off the table to create passive income that I don't have to trade time for. Now, what that helps me do is create or achieve one goal, which is how to get freedom and choice on how I spend my time. Now, here's the thing. I love spending my time educating you, a passive investor or a budding passive investor, on how to do this. Okay, and that's what we're going to talk about today, are those top mistakes. And we're going to quickly go over 12 of them. Now, this isn't going to be a deep dive episode, but we're going to highlight what are the big 12 mistakes that I see investors make. And guilty here, I've committed a couple of these myself. Now, before we do that, I just want to let you know that we can actually help you achieve your passive investing goals at PassiveInvesting.com, whether that's in our equity deals in, say, multifamily or express car washes, or if you want to earn consistent cash flow, you can invest in our debt deals like our PIC Real Estate Debt Fund. But more importantly, if you just want to get access to these deals, access to more education, be sure to join the Passive Investing Club. You can scan the QR code on your screen or visit passiveinvestingwithwhitney.com. Now let's dive into today's conversation. Okay, this is not tax advice, legal advice, financial advice. Okay, these are just the top mistakes I've seen investors make. But if you pick up a nice cool tip, trick, or a hack, make sure to take it back to your investing team to make sure you understand how it applies to you. Now, let's dive into the top mistakes. Okay, like I said, there's 12. We're not going to deep dive into these. I will point you to other resources. But let's start with the first mistake that I see passive investors make. Okay, maybe this applies to you. Is mistake number one, having no capital strategy. Okay, so the problem with this is you kind of have a ready, fire, aim approach, right? You're ready to passively invest. You're just going to go invest in a deal. You're going to find it, and then you're going to figure everything out later. Now, here's the thing, is that you might find that you get into a deal, you over allocated capital, or it wasn't a good fit with your goals, right? It's really important as a passive investor, just like any investing, really sit down and figure out what your investing plan is, okay? How are you going to plan the execution of your capital, all right? When we don't do this from the get-go, people end up in deals. Maybe this is you. You end up in deals that are not aligned with your actual goals. Then you find out, okay, I'm confused. Why isn't this working for me? And then they just underperform, okay, according to what you need. Now, here's the fix. Simply carve out some time. Okay, go back and watch our boot camps on how to create your passive investing plan. Okay, I call this our investor thesis. Okay, really sit down and define your goals, your risk, your timeline. Okay, not just risk in general, but your risk tolerance, your risk capacity. Okay, and understand what specific role you need your dollar to do. Okay, and you're going to create a plan for now. How are you going to transition the plan, say in 5 years, 10 years, and then closer to retirement? Okay. No strategy will mean no success. Okay. So we got to do this first. All right. Mistake number 2 that I see passive investors make. Okay. Maybe this is you. Okay. I know I've done this. I've fallen guilty to this, is emotional decision making. Okay. The fear of missing out on a deal. Okay. We have 5 spots left. You must invest now. Okay. Or you're in, say, a passive investing investor forum, like an online forum or a specialized group. And somebody brings a deal to the group, and then the frenzy is created. Okay, that frenzy can be used for good or it can be evil, right? So we don't want to get into emotional investing. How do we avoid that? Okay, is simply making sure that we've got a plan and that we're sticking to the plan. Before we actually write the check on any deal, we are measuring that deal according to our plan. We're maybe even inserting it into our tracking spreadsheet to make sure that our portfolio would look how we want it to look after we actually wrote the check. Okay. The cost of not doing this, okay, or investing based on an emotional decision is that you get into poor deal selection. You might overpay on a deal, you might rush into something that doesn't align with your investing goals. Okay. Okay, mistake number 3, trusting other people's analysis. Okay, there's a real danger in this. Okay, I see this happen so often. This is one I love investing groups because you can get a lot of group feedback on things. But I see a lot of investors actually skip their own analysis and due diligence and write a check into a deal they probably should never have been in. Okay, why? Because that deal met that person's goals, okay, somebody else's goals, and it doesn't meet yours. Okay, so the real danger here, friends, family bring you a deal. Okay, investment group brings you a deal. You have to pause, go back to your plan. Make sure you're making an unemotional decision. Okay, influencers are posting about the hot tactic on TikTok or Instagram Reels or even YouTube Shorts. Okay, again, it's totally fine to take a look at that, but pause, make sure that you're evaluating this deal according to your own capital plan, your own due diligence systems, and making an unemotional decision. Okay. So the big take home here is other people's criteria may not actually match your goals, your risk, and timeline. Okay. They may be super smart. You might respect that person, but it doesn't mean you guys are actually investing for the same reason. All right. Mistake number 4, marketing material dependency. Okay. So operators will put out amazing decks to try to give you as the passive investor as much information as you could possibly want or need in order to make an investment decision. Okay. A great operator is going to be able to give you that information in an unbiased way. However, it is marketing material. So you have to trust but verify. Okay, that deck does not substitute for good, high quality due diligence, analyses, and asking deep, detailed questions of the operator. Okay, so think about this. The marketing materials are meant to do just that, market the deal to you, generate interest. Okay, the operator is expecting you to ask deeper questions. All right, so this is where We can look at the marketing material, but again, you must have a great due diligence system in place to be able to pull out all that information out of the beautifully laid out deck and be able to make a good decision based on your capital plan, your due diligence systems, okay? And make it fairly unemotional. All right. Which leads us to mistake number 5, right? There's kind of a through line here, right? When I see investors that get into a deal that are misaligned with their goals, there's usually some sort of through line here. They've landed on one of these steps, okay? And they're almost like in sequential order, okay? Mistake number 5, insufficient operator vetting. Okay, the risk here is that we can get into a situation where we might overtrust an operator and skip out on proper interviews. Maybe it's because we don't have time. You've followed them on social media, so you feel like you have a lot of trust built out there. Maybe you have a friend or family member that is actually, or another respected investor that it's actually invested with that operator before. Okay, that is great. Use that as data for your own operator vetting. You gotta get on the phone. You have to have your own due diligence systems, a standardized question list to vet every operator before you invest in and deal with them. You're checking for their track record, references, and just general alignment of interest in a particular deal. All right. Mistake number 6. Okay. This is actually kind of more moving into poor market selection. Okay. So I've seen investors actually get into deals where the market they're investing in, they would never in a 10-foot, touch that market with a 10-foot pole if they were buying their own real estate that they were having to hold and manage. Okay. They're chasing a hot new theme. So an example would be, the new chip centers are being built in North Texas. Okay, that's great. And do you believe in that? Would you actually go buy a house there yourself? If not, why are you investing in that particular area if you don't believe in the area? Okay, so we want to make sure when we're investing in deals, we're actually underwriting markets and evaluating them on basic fundamentals that we believe in. And some of the basic fundamentals that we should be underwriting in any investment we go into, whether it's multifamily, self-storage, express car washes, we want to look at employment data for that particular area. We want to make sure that jobs are growing. Okay, there are plenty of jobs. The jobs are diversified. The jobs are growing. We want to look at population trends. We want to make sure that more and more people are moving to the area. We don't want, population leaving that area. Okay, if we're doing residential or commercial, multifamily type deals, we want to look at the rent to income ratios, right? Do we have balanced rent to income ratios? What is the supply demand metric in that area? We want to take a look at that. And to take it one step further, we want to see what the construction pipeline looks like in that area. Okay. We can invest in an area with strong employment, strong population trends, strong rent to income ratio. Supply demand might be neutral, okay, or maybe just a little bit of supply above beyond demand. But if our construction, our deliverables are going to be high for the next few years, that's not a good market to go into. So we want to pay attention to these matrices before we invest in a deal. Why? Because we actually can understand if we are on the growth side of the curve or if we're on the hypersupply part of the curve. All right, mistake number 7, overexposure to equity risk. Okay, so there's a trap here that a lot of people, when they get into passive investing, they're probably, and especially real estate investing in general, this is what I've seen and have experienced myself, is that you get into it because you're like, wow, I can invest in a deal and I can get cash flow, equity growth, tax benefits, all with one investment. It's like the best thing since sliced bread. However, that is if you've stuck with me for any length of time, I really try to encourage all my investors to think a little bit more sophisticatedly. Meaning, let's not try to achieve everything with one deal. Let's look at our entire portfolio allocation and make sure our portfolio allocation is delivering what we want as far as cash flow, equity, and tax benefits. Okay, so where do people get in trouble? Okay, if you go back to the capital stack, the highest risk and highest reward positions are going to be the equity positions. Okay, that means the operator and you as a limited partner are partners. You're going to make money together, break even together, lose money together. So we don't want to oversaturate our portfolio with equity deals if we don't have the risk tolerance for it or the risk capacity for it. So again, the fix here is actually looking at balancing our entire portfolio across the different layers of the capital stack, making sure that we've got one, amazing reserves in place. Okay, 6 to 12 months is usually where I land. Okay, maybe for you, you only need 3 to 6 months. Then making sure that we've got investments that are going to provide stabilized, predictable cash flow for us that are highly liquid and highly conservative. And then we can start peppering in our equity assets on top of that. We need to make sure we have a very solid financial foundation. All right. Mistake number 8. I think this is a lesson that a lot of equity investors have learned over the past couple years, but I'd be remiss if we didn't put this in our top 12 mistakes that passive investors make. So mistake number 8, ignoring debt structure. Okay, so when you invest in any deal, even today, you still want to ask for the debt structure. You want to dive into it. Is there a well, first of all, in the debt structure, are they using fixed rate debt or adjustable rate debt? Okay, there are business cases for both. Okay, those are just tools in the toolbox. What we want to make sure is the right tool is matched with the right deal. Okay, so one, fixed rate, adjustable rate debt. Okay, beyond that, we need to know the term of the debt. How long is the debt in place? So the business plan on the property is 10 years, but the debt, fixed rate debt or the adjustable rate debt's only in place for 2 years. What's happening in year 1.5 to get ready to reposition out of that 2-year debt? Okay, so we want to again watch for that timeline matchup. Then we need to look for these 4 components here. One, do we have a rate cap in place, or are we at risk for the interest rate to continue to float on us? All right, right now we're recording this in September of 2025. Everybody's on the edge of their seats. Fingers crossed that the feds are going to start, lowering interest rates, at the end of 2025. But we can actually see, even if the Fed lowers interest rate, it might mean mortgage rates pop up a little bit, okay? So we got to go back to that educational piece on how does the Fed really, truly impact mortgage rates? So again, it's always worthwhile. Is there an interest rate cap here? Debt service coverage ratio. How much income is that property bringing in? And does it cover at least all the debt service and operational expenses on the property? And if so, does it have a margin above that? Ideally of like 15 to 20% or more. Okay. Loan to value implications. Are we over leveraged on the deal? Do we actually have too much debt on the deal? Okay. That can actually impact the operator's ability to refinance that particular opportunity. And then the exit strategy. Again, this kind of ties back into what I was saying about timeline. Do we actually have the right tool being used, debt structure tool being used on the property and its business plan? All right, mistake number 9, weak underwriting validation. Okay, so we want to make sure that, again, this is trust but verify, okay? So as an investor, this is where we have to have really great due diligence systems. And if you go back to our YouTube page at passiveinvesting.com, dot is spelled DOT, so passive.com. I have tons of boot camps there for you to teach you how to put together your capital plan, how to vet the operator, vet the market, vet the deal, okay? Put together your own due diligence systems, how to track your investment, okay? I have the boot camps there to teach you how to avoid all of these mistakes. But mistake number 9 is weak underwriting assumptions, okay? Now, it's a double-edged sword, right? You, as a passive investor, have to have good due diligence systems in place to question the underwriting of the operator. But more importantly, you need to be with an amazing operator that has good vetting systems. Now, a lot of operators are learned through the past 2 or 3 years of investing with the higher interest rates and have changed their underwriting models significantly. So even if you've been with an operator that has experienced challenges, okay, before investing in another deal, you want to understand how they've changed their underwriting model for that particular asset class. Okay. Mistake number 10, no downside protection. Okay. Now, of course, we're looking at the underwriting assumptions for the project. Okay. We actually have to question those. But when I talk about no downside protection, I'm actually talking about you as the passive investor. Do you have reserves in place, not only for your personal reserves, okay, say 6 to 12 months, or if you're closer to retirement, maybe 12 to 24 months of reserves, but also do you have like a bucket of reserves set aside for your investments should there be any sort of capital issue on that? We want to cross our fingers, hoping that we have done everything we can to mitigate that risk. We never have to use those reserves, but we want to make sure that we are actually setting aside those reserves and making sure that if there are issues with occupancy on a project, or should the property hit distress because, heaven forbid, a once in 1,000-year hurricane storm hits that property, that we actually, the operator is doing that with the property, but we want to do that with our portfolio too. Okay, so make sure that you're not investing your last dollar into a deal and not having those reserves set aside. Okay, you've got some downside protection should your portfolio hit a down part of the market. Okay, you're not sweating it. Okay, that leads into liquidity blindness. When we invest in passive deals, especially in equity deals, the lockup periods can be pretty long, okay? And if you don't have your safety net in place or available capital to invest in additional opportunities that might generate cash flow, it can create undue financial stress for you and really limit your flexibility. So this is where, if you want, go back and look at all my webinars on Fortress balance sheet, okay? Or three-tiered investing. Okay, this is a great approach to help you insert those different cash flow tiers, invest across different timeline horizons and investment types. Okay, create that diversity within your portfolio. And again, I've mentioned it multiple times as we've gone through these top mistakes here today. Keep those reserves on hand. I like 6 to 12 months, maybe even a little bit higher reserves if you're closer to retirement. Remember that typical holds on an equity investment deal, even if it says 3-year hold, I would think in terms of 5 to 7-year minimum, even closer to 10. Okay, so if it's 3, I think 5 years exit. If it's 5, I think 7 years. If it's 7 years, I think 10 years exit, right? I want to make sure I am not being blind to the fact that the hold might be a little bit longer. Then we get to allocation, okay? I'm not a financial advisor. I cannot advise you on how much of your portfolio you should invest into passive real estate deals. But a lot of passive real estate investors, I've pulled them in different groups, hold about 30, maximum 50% of their investments into deals that are illiquid. Okay, that's not deals that are passive real estate deals, but just illiquid deals. So they leave a good portion of their portfolio very liquid. All right. And then mistake number 12, performance blindness. Okay. We're not talking about at the deal level. We're talking about your portfolio as a passive investor. Okay. Are you reading the monthly updates that you're getting from operators? Are you tracking, your returns that are coming in? Are you rebalancing as you get pots of money back from operators as deals exit? Are you making sure you're keeping your capital plan up to date and rebalancing what according to the needs of your capital plan? All of that means you have to have real clarity on what it is that you want your portfolio to do. Okay, so again, go back to our passiveinvesting.com YouTube page. There is an amazing webinar that I did recently on how to track your portfolio performance. That is just a simple spreadsheet you can put together. I showed you how to build the pivot tables in there to where you can measure, a lot of these different metrics and get great clarity super fast. All right. So as we wrap up today, the true cost of if you've fallen, subject to any one of these mistakes is that one, your portfolio becomes misaligned, you have unclear investment direction, okay? You're just getting really inconsistent returns. You might end up in deals that cause losses or delays, okay? You might end up with some surprise expenses, okay? If you end up in deals that have like bad debt or halted distribution. But more importantly, the reason why I want to help you avoid these mistakes is so you aren't subject to the stress of being illiquid in a time when you actually need the cash flow or the cash in order to make your next equity deal or your next investment deal. All right, so how do we avoid this? Okay, we've gone over the 12 mistakes. We talked about why it's important for you as the investor to really work through putting in tools in place to avoid these mistakes. But I want to leave you with a quick 4-step kind of strategy, right? Maybe solving 12 different points seems a little overwhelming. Okay, point number 1, make sure when you're putting together your capital strategy that you're mapping for capital preservation, cash flow, making sure you've got your liquidity layers in place and that you are growing wisely. So preserve liquidity, cash flow, and growth. Step number 2, upgrade your investment filters. Okay, that is the second thing you can do to help avoid these 12 mistakes. So one, getting really clear on your investor thesis, your goals, your risk tolerance, your risk capacity, your timeline. Okay, putting together your operating, checklist, both for your operator, but also for your deal. Okay, and then stress testing that deal. Don't rely on emotional reaction. YouTube shorts or Instagram shorts, export shortcuts, investment groups, or friend recommendations. Do the work yourself. And then step number 3, build your portfolio protection and flexibility systems. Make sure you're reviewing your portfolio on a quarterly basis, making sure that your diversification strategy is staying intact across, lower risk assets, liquidity, cash flow investments, making sure that you're spreading out your portfolio risk amongst multiple operators, markets, and investment timelines. And then again, making sure that you've got some optionality for future investment. All right, so if this hits home, okay, what we are here to do is help you review your current plan, understand what pillar or what layer of your investment plan that you might need to build out, and to help you match to a better investment strategy that will help you achieve your plan. So if that sounds interesting to you, make sure to reach out to me at passiveinvestingwithwhitney.com. Now, if you're here live, don't go anywhere. We're going to start the Ask Me Anything part of our show. Could you guys hear me? I show that I have audio here. Somebody put in there, I'm not getting any audio. Anyone? Anyone? Okay, cool. Yay. Perfect. Thank you. Yay, you guys are awake. Okay. All right, questions. Oh, every GP says their underwriting assumptions are conservative. How do you verify if they truly are? Well, conservative, that is great, and I feel your pain. Okay, so this is where conservative means different things to different people. Okay. So you have to determine for you, according to your due diligence system. So back this up. Put together your investment thesis. Okay. Go watch the YouTube videos on how to do that. Put together your investment thesis. That's going to tell you, should you be in the debt layers of a deal, equity layers of the deal, or somewhere in between? Maybe like promissory notes are a good thing. A preferred equity class of a common equity deal might be a good thing for you, right? Okay. So first do that. Okay. Then create your due diligence systems according to your investor thesis. Okay, don't take somebody else's due diligence checklist and then just run it and assume that it's going to catch everything. The reason is that it's going to be built for that investor's ideal investment. So you want to make sure that you're taking that checklist and ordering the questions on like what you want to see, right? What does conservative mean to you, right? For me, I might be totally fine going into a deal that has 75% levered. Okay, I would call that conservative. Okay, I might call aggressive 85% levered. Okay, you might be in a different phase of life. You might want to be, you consider conservative 65% levered and aggressive 70% levered, right? So again, you have to determine what that means for you. So you got to start with the investor thesis, adapt your checklist for your investor thesis. That is then going to tell you, you're not going to let the operator say, hey, our investments are conservatively underwritten. You're going to go, thank you, amazing information. I'm going to take this back and you're going to run it according to your checklist. And then your checklists are going to tell you if it's conservative for you or not. Okay, hopefully that makes sense. Okay, that is the only way that you can get matched into the right deal. Okay. So for me, I don't do the 80-85% levered deals. Okay. Somebody might tell me all the reasons in the world why these deals, 80-85% levered deals are amazing. But to me, that's too aggressive. But also, I think 60% is too, 60% loan to value is too conservative, right? For me, my definition of conservative is much different. So again, this is very personal, okay? So does it mean you have to start from scratch? No, it just means you can take somebody else's checklist, but make sure to adapt it to your investor thesis. What other questions do you have? Um, so is the follow-up question, maybe we should talk one-on-one because I'm not talking about LTVs. Yeah, I was just using LTVs as an example, right? And that can apply to different areas. It can apply to expense growth, vacancy, operational expenses, CapEx, right? You're going to have like conservative values or conservative percentages that you're comfortable with, and then ones that you feel are so aggressive or too aggressive, right? Every metric in your due diligence checklist is going to have an ideal, conservative, and an aggressive kind of grading to them. All right. And then you're going to take that operator data and you're going to simply grade it. Does it get an ideal checklist checkbox? Is it super conservative checkbox, or is it too aggressive? And then if you got more column checks in that column for aggressiveness, maybe they're too aggressive on their loan to value, too aggressive on their the loan the whole time on the loan. Maybe they're too aggressive with their rent growth. Maybe they're too aggressive on their expense ratio staying really low. Okay. That's how you're going to do it. You're going to checklist it. And there's too many things in there, too many checks in the aggressive category, and you are not comfortable with it. That is what's going to determine if it's too aggressive for you. But again, it doesn't mean that assumptions are necessarily off. It just means they're not aligned with you. That's what we need to figure out is the alignment piece. Okay. But yes, if you need to jump, anybody here wants to go into any additional detail, want to pick my brain further, make sure you go to passiveinvestingwithwhitney.com there. You can fill out a quick little form and then you can get on my calendar. All right. What other questions do you guys have? A question that I have for you is, what did you love? What would you have loved to have seen? I do these webinars for you every week. The I get my best ideas from you, our investor. And so I would love to know what question that I can answer for you. And if there was a question that was unanswered in this video, make sure to put it into the Q&A box or chat box, and we will go from there. All right. Well, if there's no more questions, I really appreciate you not only taking your time to spend it with me today, but also taking the time to invest it in yourself. Take care.